There's a strange moment that happens in modern life when someone looks at their paycheck and quietly thinks, I should be doing fine. The number looks respectable. It's higher than what they made 5 years ago, maybe even double. On paper, it feels like progress, like the kind of income that should create breathing room. And yet, somehow, by the end of the month, the bank account still feels tight. The credit card balance never quite disappears, and the sense of financial pressure never really fades. If you've ever had that thought, that subtle confusion between what your income suggests and what your life actually feels like financially, then you've already brushed up against something economists sometimes call the high-income poverty trap. My name is Daniel, and in this video, I want to think through something that has quietly become one of the strangest financial patterns of modern life: how people can look wealthy on paper while feeling financially fragile in reality. If you look around the United States today, it's actually becoming more common to see households earning six figures while still feeling financially stretched. A household income of $120,000 or even $150,000 used to represent a very comfortable lifestyle in most parts of the country, and in some places it still does. But in many cities today, that same income can somehow produce the exact same financial anxiety that people used to associate with much lower salaries. The interesting question is not simply whether things have gotten more expensive. Inflation certainly plays a role, but the deeper question is how spending patterns have quietly adapted themselves to match every increase in income. Human psychology has a fascinating way of adjusting expectations almost immediately after circumstances improve. When someone moves from earning $50,000 to $80,000, the first few months can feel incredible. There's more freedom, more flexibility, and often a sense of relief. But slowly, almost invisibly, new financial commitments start forming around that higher income. Maybe the apartment upgrade feels justified because the new salary supports it. Maybe the newer car seems reasonable because the monthly payment fits inside the larger paycheck. Maybe subscription services, travel habits, dining patterns, or convenience spending expand just a little bit. The strange thing about lifestyle inflation is that it rarely feels reckless in the moment. Each individual decision seems rational. The nicer apartment improves quality of life, the newer car feels safer and more reliable, the extra services save time. But what gradually forms is something that economists sometimes call fixed cost gravity. Instead of expenses being flexible, they slowly become locked in place. Housing payments, car loans, insurance premiums, subscription stacks, and lifestyle expectations become permanent parts of the monthly budget. Once those fixed costs form, something interesting happens psychologically. The higher income that once felt liberating begins to feel necessary. Instead of the salary being optional progress, it becomes the minimum required just to sustain the lifestyle that is developed around it. The paycheck is no longer building wealth, it is maintaining momentum. A good way to understand this is through a simple example. Imagine someone earning $140,000 a year in a major U.S. metro area. After taxes, their monthly take-home pay might be roughly $7,800, depending on state and deductions. Now let's look at how easily that money can disappear without anything extravagant happening. Rent or a mortgage might be $3,000 per month in a high-cost city. A car payment and insurance together might reach $900. Health insurance and medical costs might average another $500. Utilities and internet could reach $300. Groceries for a household might run around $800. Add student loan payments of $600, and suddenly we're already approaching $6,100 before entertainment, travel, subscriptions, clothing, or unexpected expenses. This is where the trap becomes visible. On paper, $140,000 still sounds like a powerful income, but the margin between income and obligations becomes surprisingly thin. And margin, more than income itself, is what creates financial stability. Margin is the quiet gap between what you earn and what you absolutely must spend. It is the financial breathing room that allows savings, investing, and resilience during emergencies. When margin disappears, even high earners can feel financially fragile. There's also another psychological layer that makes the high-income poverty trap more difficult to recognize:
comparison. Humans instinctively measure their success relative to the people around them. If someone earning $140,000 lives in an environment where neighbors are earning similar or higher incomes, the lifestyle expectations of that environment quietly redefine what feels normal. Suddenly, the upgraded kitchen, the frequent vacations, the private school tuition, or the constant dining out no longer feels extravagant. It feels standard. The spending doesn't feel like indulgence, it feels like participation. The problem is that participation can scale infinitely with income. The higher someone climbs financially, the more expensive the normal environment often becomes. There's an interesting behavioral finance observation about this. People tend to judge wealth based on visible consumption rather than invisible assets. A person driving a luxury SUV, living in a beautiful home, and traveling frequently appears wealthy from the outside, but those signals often represent spending rather than accumulation. Real wealth tends to look surprisingly quiet. It appears as brokerage accounts growing in the background, retirement contributions increasing steadily, and expenses that remain relatively controlled even as income rises. One of the most revealing financial questions someone can ask themselves is not what do I earn, but how much of what I earn is actually staying with me. Because wealth is not measured by income, it is measured by retention. Let's run a small piece of math to illustrate this. Imagine two households earning the same $130,000 a year. The first household almost spends everything they earn after taxes. They might save $3,000 per year without realizing how small that number really is. The second household intentionally preserves margin and manages to invest $25,000 per year. Over a single year, the difference doesn't feel dramatic, but over 20 years, assuming a modest 7% annual return, that second household's investments could grow to well over $1 million. The first household, despite earning the exact same income, would remain financially dependent on their next paycheck. This is the subtle difference between looking wealthy and becoming wealthy. And what makes this even more fascinating is that the high-income poverty trap rarely feels like a trap while it is forming. It feels like progress. Each upgrade seems logical and earned. Each new expense seems justified by the larger income. But slowly, the financial structure becomes more rigid. The lifestyle that once felt like freedom becomes a system that must be continuously funded. At this point in the conversation, if you enjoy these kinds of thoughtful reflections about money and the psychology behind financial decisions, consider subscribing to the channel. My goal here isn't to lecture about money, but to think through the patterns that quietly shape our financial lives. The deeper realization behind the high-income poverty trap is that income growth and lifestyle growth often move in the same direction at the same speed. If every raise is matched by a slightly larger house, a slightly nicer car, slightly more convenience spending, and slightly more lifestyle upgrades, then the financial margin never expands. And without margin, income alone cannot create stability. This is why some households earning $70,000 feel financially calm, while others earning $200,000 feel constantly pressured. The difference is not the number on the paycheck. The difference is how much space exists between income and obligation. One metaphor that helps explain this is the idea of financial weight. Each fixed expense adds weight to your financial structure. A small apartment might weigh very little financially. A large apartment might weigh a lot. A paid-off car weighs almost nothing. A large car payment adds significant weight. When enough weight accumulates, the financial structure becomes extremely sensitive to disruption. A job change, a medical issue, or an unexpected expense can suddenly feel threatening because the system requires constant income to stay upright. By contrast, people who maintain margin build structures that are surprisingly resilient. Their lifestyle is lighter, their financial obligations are flexible, their income supports their life rather than holding it up. Another interesting observation is that people who eventually build real wealth often follow a pattern that looks boring from the outside. Their housing expenses remain controlled even after their income increases. Their cars stay practical longer than expected. Their savings rate rises alongside their salary rather than their lifestyle. From the outside, this behavior can appear conservative or even overly cautious, but over time, it creates something incredibly powerful: optionality. Optionality is the ability to make life decisions without immediate financial pressure. It is the freedom to change careers, take time off, start a business, relocate, or handle emergencies without financial panic. And optionality rarely comes from income alone. It comes from the quiet accumulation of financial margin. In a way, the high-income poverty trap is really a story about how modern life subtly encourages us to spend future freedom in exchange for present comfort. Each upgrade is small, each payment is manageable, but collectively they reshape the financial structure of our lives.
When people feel financially stuck despite earning strong incomes, the solution often isn't dramatic budgeting or extreme frugality. It's simply noticing where margin has slowly disappeared. Sometimes the most powerful financial move is not increasing income, but preventing lifestyle expansion from absorbing every raise. Because when income grows but expenses grow more slowly, something remarkable begins to happen. Financial pressure gradually fades. Savings grow quietly in the background. Time horizons become longer. Decisions become calmer. Money stops feeling like something that must constantly be chased. And ironically, that calm financial structure often produces the kind of stability that people originally hoped a higher income would provide in the first place. So the real lesson behind the high-income poverty trap isn't that high earners are irresponsible or careless. It's that modern financial environments are incredibly effective at absorbing every increase in income unless we intentionally create space. Because at the end of the day, wealth isn't defined by how impressive a lifestyle looks from the outside. It's defined by how much freedom exists behind the scenes. If conversations like this help you think differently about money, consider subscribing to the channel. And I'm curious about your perspective on this. What's one expense or lifestyle upgrade that you've noticed quietly expanding as your income increased?